Hey guys, it's Cameron here with Emerson House Buyers. Every week I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable rental portfolio in about 2 years. Today I want to talk about rules of investing. So I've had a lot of questions recently about the stock market and how we invest and how to look at certain investments. And it really came down to three things. So you want to have something that minimizes activity, meaning you don't trade in and out of it. You're going to have to be disciplined because it's going to take a long time to build up to have this. It's almost like a snowball, compounding interest starts out slow and almost inconsequential and insignificant. And then over 10, 15, 20, 30 years of that same discipline, you have something huge. So discipline. And then the last one's focused diversification. And I'm going to go into more detail all those, but those three are really the main tools, or should I say rules around investing and how you ought to look at investing. So number one, again, you want to look at something with minimal activity. So when you get into something, whether it's a stock or real estate, there are always costs. Even if you guys are looking at cryptos, there's a huge expense to get in and out of these things. And it can really dampen your effect. So if you got to pay 2, 3, 4, 5, 6, 10% every time you buy something, you got to pay that when you sell it, or every time you sell it, you're going to have to pay it. So look at a stock, for example. Sometimes the trading commissions are 2 to 5%, especially if you're going through a brokerage house and you have to call them. There's administrative fees. If you look at real estate, when you have to buy and sell, there's a lot of closing costs, doc fees, attorney fees, realtor fees, HOA transfer fees. There's all sorts of things that you have to pay. So again, you're going to have your return. It's going to be inhibited by that. So it's got to overcome your closing costs and then some. Does that make sense? You're going to have your return and then your costs every time you trade. Buy and sell and trade, it's going to reduce it by that amount. So Warren Buffett talks about it in several of his books, but minimize those transaction costs. Just try to own the whole market. So he looks at investing in stocks, specifically in businesses, but if you look at it, same thing with real estate or any other investment you make, the more, you just want to own the pie or own the best pieces of the pie and write it out. You don't have to buy and sell and trade and have to look at it quite a bit. So that's number one. Number two, discipline. This is probably the hardest rule. Everybody wants to be, an overnight millionaire, but if you listen to any of the big guys talk about it, it takes years to become an overnight success. So these people have done something, whether that's Zuckerberg with Facebook, whether that's Warren Buffett, they've built up their skills and honed their skills for years. And then one day or 1 year, they finally had the straw that broke the camel's back, per se, in success, and it opened up the floodgates. But you'll have to be disciplined every year. So if you're looking at stocks and buying stocks, you want to dollar cost average, which means buy the same amount every month. And if you do that over 10 or 15 years, you cannot help but have a huge portfolio. You cannot help but become more and more financially secure. I hope that makes sense. I know it doesn't, it's not what anybody wants to hear, right? But if you look at your portfolio, it is going to be the culmination of a bunch of disciplined habits over the years. And if you're buying and selling, or you're not you put in a lot of money and then, something happened, or I have something going on, and you're not prioritizing that, you're prioritizing maybe a new car or a new house over your investments, over time, that portfolio is not going to be as robust and powerful as it could be. So discipline is a huge one. Putting that stuff first, paying yourself first is what Robert Kiyosaki calls it in Rich Dad, Poor Dad. So paying yourself first. And the last one I was saying is focused diversification. So in real estate, you can, just say you're looking at real estate and saying, okay, well, how do I diversify? So people will tell you, well, go out and buy stocks, go out and buy bonds, go out and buy gold, go get in some cryptos, do some note investing. But really what you can do is do focused diversification. So if you're a landlord and you're really good at being a landlord and you want to have rentals, You can buy rentals in different cities. You can buy rentals in different parts of town. You can buy low-end rentals and high-end rentals. High-end rentals and low-end rentals. You know, you can diversify within your wheelhouse. Warren Buffett does it. He might talk about diversifying, but he analyzes businesses and buys them. He buys different businesses, but his model is still the same. He's still looking at it and putting it through his same filter. So he's still staying in it. Bill Gates, same way. Zuckerberg with technology, same way. Steve Jobs, all these people have done focused diversification. Products, whatever you want to call it. So when people start getting out of that wheelhouse to diversify is when they get in trouble. A great example is when people go from single family to multifamily investments in real estate. So they think that because they're doing well in single family and they want to make the jump to multifamily to go bigger and better or diversify, they get hurt. And they don't, the same tactics and tools are not the same for multifamily that they are for single family. So I just want to emphasize those 3 points, guys. Again, you're going to have to be diversified. You're going to have to have a lot of discipline, and you're going to have to not trade a lot. Trade, discipline, diversification, focus, diversification. Those 3 things, if you use that in your investment strategy, you cannot help but come out with something that's a lot better than what you will on the alternative. And guys, again, I'm not just creating this stuff. This is some of the best of the best information that I've had that I've gone through. But if you boil it down to these 3 things, I could probably create a list of 100 things. But these are the foundation. These are the pillars. These are the main points of this investing strategy. So I hope that was helpful. If it was, let me know. If it wasn't, let me know. But I think you guys, it would behoove you to use those 3 things in any investment you make or any venture you partake in. See you guys next week. Thanks.